In June 2021, ProPublica got their hands on something that was never supposed to see daylight. Thousands of pages of confidential IRS tax data spanning 15 years on the wealthiest people in America. What they found should have started a riot. While you were losing 20 to 30% of your paycheck to the federal government, the 25 richest Americans were paying a true tax rate of just 3.4%. Jeff Bezos, the richest man on the planet, paid zero federal income tax in 2007 and again in 2011, when his net worth was $18 billion. Elon Musk, zero federal income tax in 2018. Warren Buffett, the Oracle of Omaha, a man worth over $100 billion, paid an effective tax rate of 0.1%. That's not a typo, 0.1%. But here's the thing that should really keep you up at night. They weren't cheating. Every single one of them was following the rules. Rules that were specifically designed for people like them. There's a playbook, a strategy so elegant, so brutally effective that has been passed down through generations of American dynasties. The wealthy call it 3 words, and by the end of this video, you'll understand exactly how it works. Let's talk about the world you live in versus the world they live in. If you earn a salary, congratulations. You're trapped in what I call the W-2 prison. You work, you get paid. The IRS takes their cut before you ever see a dollar. Social Security tax, Medicare tax, federal income tax, and if you live in a state like California or New York, they want their piece too. By the time the money hits your checking account, you've already lost a quarter of it, maybe a third. Now let's look at how a billionaire's finances work. Here's something most people don't understand, and I'm going to explain it as simply as I can. There's a massive difference between income and wealth. The IRS doesn't tax wealth, they tax income. If you own a stock worth $1 million and tomorrow it's worth $2 million, you just made $1 million, right? Wrong, at least as far as the IRS is concerned. That $1 million gain is what we call an unrealized gain. It only exists on paper. You haven't sold anything. You haven't realized the profit. And until you sell, you owe nothing. So while your income gets taxed the moment your employer cuts your paycheck, a billionaire can watch their net worth grow by $10 billion in a single year and owe absolutely nothing to the federal government. Jeff Bezos' Amazon salary? Around $80,000 a year. That's what he reports as income. His actual wealth increase in 2020 alone? Over $70 billion. That's not a tax loophole, that's a completely different tax universe. But here's where it gets interesting. Because not paying taxes on your wealth is only step 1. The real magic happens when you figure out how to actually spend that wealth without ever converting it into taxable income. Step 1. Acquire assets that appreciate in value. We're talking stocks, real estate, fine art, private equity stakes, crypto, anything that grows in value over time. The key is to never sell. Warren Buffett has famously held on to Berkshire Hathaway stock for decades. He doesn't take dividends, he doesn't cash out, he just holds. And that's intentional, because the moment you sell, you realize the gain. You trigger a taxable event. Capital gains tax kick in, up to 23.8% for high earners at the federal level. But if you hold, if you just sit on appreciating assets and watch them grow, you can become one of the richest people on earth and owe next to nothing. But that raises an obvious question. If you never sell, how do you actually live? How do you buy the jet, the yacht, the 4th vacation home? This is the part that changes everything. Instead of selling stocks and paying 20+% in capital gains, billionaires do something much smarter. They borrow against them. It's called a securities-backed line of credit. Here's how it works. You walk into a bank, let's say Goldman Sachs or Morgan Stanley, and you say, I've got $100 million in Amazon stock. I'd like a loan. The bank says, great, we'll lend you $50 million. Your stock is the collateral. The interest rate? For wealthy clients with 8 or 9-figure portfolios, we're talking a spread of around 2 to 4% over SOFR, the benchmark rate banks use. High net worth clients can negotiate rates significantly lower than you pay on a mortgage or a car loan. Now, here's where the math gets beautiful, at least if you're a billionaire. Let's say you need $5 million to buy a house. You have 2 options. Option A, sell $5 million in stock. You owe capital gains tax, let's call it 20%. That's $1 million going straight to the IRS. Option B, take out a $5 million loan against your stock. Pay 3 to 4% interest annually. You keep your stock. It keeps appreciating. You owe the IRS nothing. Which would you choose? The ProPublica investigation found that Elon Musk had pledged 92 million shares of Tesla, worth over $50 billion at the time, as collateral for personal loans. He's not spending his income. He's spending borrowed money. and borrowed money isn't income. It's not taxed. This is the final piece, the part that makes this whole system not just effective, but permanent. Eventually, even billionaires die, and when they do, something remarkable happens. It's called the step up in basis. Let me explain. When you buy an asset, say stock for $100, that's your cost basis. If you sell it later for $1,000, you owe capital gains tax on the $900 gain. But if you hold that stock until you die, your heirs inherit it at its current market value, $1,000. The original $100 cost basis is erased, stepped up. If they sell immediately for $1,000, their gain is zero, their tax is zero. Let me put real numbers on this. If Jeff Bezos holds his Amazon stock until death, all those unrealized gains, hundreds of billions of dollars that were never taxed during his lifetime, get passed to his heirs with a clean slate. The estate pays off any outstanding loans from the security-backed lines of credit, and the heirs get the remaining assets, and the IRS gets almost nothing. According to the Joint Committee on Taxation, the step-up in basis cost the federal government approximately $58 billion in far-gone revenue every single year, and over half of that benefit flows to the top 20% of estates. This isn't just tax avoidance, this is generational wealth preservation on a scale most people can't even comprehend. So why isn't this illegal? That's the question everyone asks, and the answer is uncomfortable. The system was designed this way. The US tax code treats income from labor differently than income from capital. You work for a paycheck, you're taxed immediately. You hold assets and watch them grow, you're only taxed when you choose to be. The stated rationale? It encourages long-term investment. It keeps capital in the markets. It promotes economic stability. But the practical effect is something else entirely. It creates what some economists call a permanent aristocracy. Families where wealth never leaves the bloodline, where the advantages compound generation after generation, where the rules of the game simply don't apply the same way. The ProPublica data made this painfully clear. Between 2014 and 2018, the 25 wealthiest Americans saw their collective net worth increase by $401 billion. The total federal income taxes they paid during the period? $13.6 billion. Meanwhile, an estimated 14 million middle-class households paid about $143 billion in taxes the same year that the top 25 paid just $1.9 billion. There have been attempts to change this. The Biden administration proposed treating death as a realization event, meaning capital gains would be taxed when assets transfer at death. It went nowhere. The step-up in basis has survived every reform attempt since 1976. Lobbying efforts, political contributions, the sheer complexity of unwinding estate planning structures that wealthy families have built over decades. It all adds up to a system that resists change. Alright, so you're probably not a billionaire. Neither am I. But here's the thing. The principles behind buy, borrow, die aren't exclusively for the ultra wealthy. If you own a home, you have access to a smaller version of this, the HELOC, home equity line of credit. Instead of selling investments during a market downturn or liquidating assets to cover an emergency expense, you can borrow against your home equity at a relatively low interest rate. You avoid triggering capital gains, you stay invested. Some brokerage firms offer security-backed lines of credits to clients with portfolios of $100,000 or more. Not exactly blue-collar money, but far from billionaire territory. The concept is the same. Borrow against appreciating assets instead of selling them. In the step-up in basis, that applies to everyone. If you inherit your parents' house or stock portfolio, you get that stepped-up cost basis too. It's one of the few parts of the system that actually helps regular families. Now, I have to say this clearly. I'm giving you information, not advice. Everyone's financial situation is different. Tax laws change. Before you do anything based on this video, talk to a qualified professional. But understanding how the wealthy think about money, taxes, and time horizons, that's not restricted information. That's just knowledge most people aren't taught. The dark capital isn't built on breaking the law. It's built on knowing the law better than everyone else. The buy, borrow, die strategy isn't a secret. It's been documented. It's been reported on, and the IRS knows it exists. And yet, it continues, year after year, generation after generation. Because the people who benefit from these rules are the same people with the resources to ensure they never change. If you found this video valuable, If you want to understand how corporations like Amazon can report billions in profits and pay zero federal income tax, subscribe to Dark Capital. We're just getting started.